So what is profit? Well, the reality is profit is all sorts of different things. So you might hear gross profit, operating profit, net profit. Well, actually there's 3 different types of net profit, believe it or not, and so depending on who you're talking to, they might be meaning something subtly different from somebody else. You might then also hear a few acronyms that fly around: EBIT, PBIT, EBITDA. What's it all about? What does it mean? So if I kind of think about a profit and loss account or an income statement, I'll work down the page. So the first profit number that you will come to in a profit and loss account is something called gross profit. Gross profit is designed to show you how much money you make from the provision of your goods or your services. So it only includes the costs that are directly associated with doing that. What that then means is it's a much more meaningful metric for businesses that physically manufacture or produce something, because they've got all of that cost. Okay, so that might be you're a service provider who has to buy something from a supplier to provide it to your customer, or it might be that you're actually physically buying stock and materials and making something, or wholesaling it or retailing it. For those sorts of businesses, gross profit is really, really pertinent. It tells you how effectively are you pricing things, how effectively are you buying things, and ultimately as a business, you can only make money if you're making enough gross profit to cover all the other running costs of the business. Much less relevant for a service-based business, because you're not buying those materials. You're not buying those licenses, that software, that whatever it is to supply onto a customer. So that's what gross profit is designed to do. Another kind of piece of terminology that is used interchangeably is contribution, because if your business is making gross profit, it's making a contribution to all of the other running costs of the business. And if it's generating enough contribution, you'll make money overall. This is where we can use margin percentages. They start to tell us trend. They start to tell us if things gone up, have they come down? Why is that? Is it because right now the cost of materials is so much more? Is it because the cost of shipping is so much more? Is it because we've got delays in sourcing product from the Far East? The impact of the war in Ukraine is delaying the supply of goods and services. Brexit is having an impact on our ability to source things. That then means we either need to put our price up, or we need to accept that we've got what we call a lower margin. So that's gross profit. Then we would have a big chunk of cost that, depending on where you are, will either be called operating expenses, other operating costs, administrative expenses, but the most common word for them is overheads. And these are the costs that your business has every day, irrespective of whether it sells one thing or it sells lots of things. They're the what we call indirect costs, the ones that you're going to incur no matter what. So paying people's wages, advertising, marketing, insurance, rent, rates, those kind of costs. Okay? And when we take all those away from gross profit, that's where we're left with operating profit. This is where it becomes a bit more agnostic as to what type of business you are. Your operating profit is going to tell you on a day in, day out basis, how effective am I at making money? How effectively are we managing this business? Okay. There's only a couple more costs would then come off that. So the only remaining costs in the business are the cost of borrowing money, so interest, and the cost of paying the government tax. Operating profit has a couple of interchangeable acronyms. So it might also be referred to as profit before interest and tax, because guess what? Interest and tax have yet to come off. Or earnings before interest and tax, EBIT. And EBIT is this one that is very similar sounding to EBITDA. You hear lots of people talk about EBITDA. Very few people that talk about EBITDA actually understand what it is. So EBITDA also strips out 2 items of cost, or 2 areas of cost that the business may have. depreciation and amortization. They are the way that we spread the cost of the bigger items that your business buys, the infrastructure stuff, so what we call fixed assets. And whether it's depreciation or amortization is for another day. But taking that out, why do people use that? Well, what people use EBITDA for is valuing companies. It's a mechanism to remove a great deal of the subjectivity of how a company has been run and compare like for like different businesses. So it can also be used as a bit of a proxy for cash flow, but EBITDA is a really useful tool for doing what people call using an earnings multiple. And you might hear people talk about 5 times EBITDA or 10 times EBITDA, and it gets you to a rough valuation of what that company is worth. But a more practical level on a day in, day out basis, basically telling you what's the underlying trading performance of that business. So if we strip out the fact that we've had to invest in some infrastructure, and we strip out the fact that we might have had to borrow some money, and the fact that we've all got to pay the government, how are we doing? That's what EBITDA is designed to do. So we then have these different variations of net profit. So we have profit before tax, which is the one where we've taken off interest. We have profit after tax, which is the one where we've taken off the tax. And then when we get down to what we call the bottom line, we've got 2 choices. Hopefully we've still got some profit left. We've got 2 choices. We either keep it, we make it what's called retained profit, or we pay it back to our shareholders as a dividend. And the reality is, for most smaller businesses, they're doing both of those things all of the time. But retaining profit is the most effective way you can fund your own business. It's the cheapest source of money. It's the most flexible source of money. You don't have to pay it back. You don't have to pay interest. So it can really enable the growth of your business. But obviously, investing in a business is something that you want rewarding for, and so dividends are a really important part of that picture as well. So what is a good level of profit will vary from business to business. I've done some work with a wholesale business that makes only 15% gross profit. 15% of a lot of money is still a lot of money. That enables them to cover all of their overheads and still be left with profit after tax. Some service-based businesses will have 95, 98, 99% gross profit, but it might be a smaller amount of money overall. So you get this flow down the page, and therefore kind of what good looks like is a really subjective thing. The key to using profitability is knowing what those measures are designed to do and what they're designed to tell you, but also having something to compare them against. So what did you do last year? What were you trying to do this year? What's your plan? What's your forecast? What's your target? Compare against any of those things, or hopefully all of them, and you get a sense of, are we doing okay? Are we doing well? Are we doing better than we thought? Are we not doing as well as we thought? And then, even more impactful is to go, okay, so why? Why are we doing what we're doing? Is it that we've sold a different mix of things? Is it that stuff's cost us more? Is it that stuff's cost us less? And that then prompts some of the decision making within the business.